Hey, deal makers, welcome to the show where it's all about financial freedom with real estate. Let's do this. So today we're going to talk about fund to funds, everything about fund to funds and what it is and why you should consider it if you're raising capital, or if you're an operator, why you should actually partner with fund managers as well. And if you're passively investing, what is a fund to funds and what it's like to invest in a fund to fund. So we're going to talk about all of that because it's a meaningful career path for people getting into syndications. Either if you're an active investor and you're partnering, or you want to become a capital raiser, or you're an operator, you want to partner with fund to fund managers, or you're, like I said, or we're investing it. So we're talking all about fund managers today and raising capital. Before we do that, shout out to Eugene, who left us a review on Amazon for the yellow book, Financial Freedom with Real Estate Investing. He says, this book has great insight on apartment investing. Whether you're a lead or a passive investor, it really gives you an understanding of the risks and rewards, helping you to minimize risk and avoid analysis paralysis. So thanks, Eugene, for sharing your experience. If you have not yet checked out the book, do that on Amazon. It's called Financial Freedom with Real Estate Investing. And also, if you enjoy this show, we'd love to get a review on iTunes for the podcast as well. So with that, I want to bring on our co-host, Garrett Lynch. What's going on, Garrett?
What's going on, Michael?
Before we get into fund to funds, which is a fascinating topic, one of the things that I want to talk about is how to add value to a property. Because when we buy a property, there's things that we do. Obviously, the biggest one is we do some renovations, and then allows us to slowly increase rents as the quality of the property improves. But there's other more creative ways that we can consider. So what are some of the things that we have either done or maybe we've considered?
Yeah, so there's really two paths to go with this. You can obviously upgrade amenities and create just the overall better living experience for the tenant, and that's going to just drive up your occupancy, hopefully. You can offer that stuff, but you can also add individual things that are either generating revenue for you directly, or you're able to bill back to the tenants. So an example of something that you can put in on your property that you can bill back directly to the tenants is valet trash. So you put that trash service around the site, they'll charge you something like $10 a door. You charge the resident 25 a door, and times the entire site monthly. That's a large amount of revenue that you can pick up. But there's other things that you can add that are maybe not a direct impact to the pricing on your property and the rents, like solar panels, like billboards. So solar panels, that's pretty obvious. You throw them up. We've never actually gone that route, but something that you can finance. You can throw up as a way to lower your electricity bills, even provide electricity to other properties. There's billboards. So if you have frontage on a road that's a main road, there are companies that'll come out and essentially lease your land from you so that they can put billboards up. And they're digital billboards. You can even get a space on a billboard for your property. That's a really cool thing that we've talked to people about and tried to implement. You can also do electric vehicle parking stations. That's a cool thing that's more relevant now that you can add in even preferred parking. So adding in preferred parking, where somebody parks in front of their door, they're going to pay you for that on a reserved level. Also, Wi-Fi. We've done this before. We added in Wi-Fi into an entire property. We ran fiber cables underneath the property, and then each one had this little Wi-Fi box that they could just really quickly and easily log into an app and add Wi-Fi into their unit without having to go through one of the major providers. So there's a lot of things you can do. Additionally, one thing I love to do is package lockers, where it just creates a better environment for people to pick up their packages 24/7, then keeps them out of the office. And just all these things add revenue, make you kind of showcase that you know what you're doing when it comes to adding value to these properties. And it's just they're good ideas to do.
Yeah, so we want to be creative with these things, and I think one thing we found that really makes a difference for us is really to actually drive the comps, right? Because imagine you're a tenant and you're looking around, you're going to look at the 3 or 4 properties around you. How are you different? How are you better? How are you worse? What can you provide that the other property already provides, so you can be competitive, or does not already provide? So we found that increasing income at, even like you said, $25 a unit, times 100 units is a material thing. And therefore you can either make more money or you can actually pay more. And then now the other party thinks you're overpaying when you know something that the other party maybe does not know. And that's pretty cool. The other thing we do, though, talk about the tax abatement, and that's a huge value add strategy. We actually work into the model as well.
Yeah, so there is a strategy out there that's mostly you find it in Texas, called an HFA, and it allows you essentially to you have to do some things, but you can wipe the taxes off your property indefinitely for like 99 years. And it's typically you use an advisor to kind of navigate you through the system with that, and it may go away, but we've explored this before. We have friends that are doing this. Again, you're going to find it most often in Texas, and it's going to be called something different in other states. And you have to pay money up front and ongoing, so it's not free. But if you can wipe 500K a year off your taxes, it's probably worth it.
Yeah.
So that's a cool thing that we found as well. That's more of a recent item.
One of the things that's slightly less advanced is simply just challenging the taxes, right? Do we do that as well? So when we get the property tax bill, we can hire attorneys that literally challenge the tax bills, and we do that every year or so.
And they're not all the same, by the way. So in your market, there's going to be somebody that's a rock star ninja that knows how to get your tax bill down. And not
Yeah.
everybody does that. Some people offer a version of that, but you may have to ask around to find out who that ninja is that actually has the inside track on this stuff and can get things passed.
So again, once you get into a property, you stabilize it and you start your construction and you're doing the basic stuff, in year 3 or 4, really think about other creative ways that you can actually increase NOI. It's very powerful when you layer one on top of the other. So with that, let's talk about fund of funds a little bit here. So here's the whole thing about fund of funds is, is a class of people who are, called capital raisers. There's people who specialize in raising capital. And I always talk about there's two major roles in syndication. One is the deal finder and the capital raiser, right? So for example, if you were to work with us in our mentoring program, you're going to learn the fundamentals of apartment building investing, everything you need to know. But then people typically specialize either into a deal finding because they're a little more analytical, detail oriented, more numbers people, and then more on the capital raising side, from a personality perspective, people who are more relationship oriented, things of that nature. So those are both distinct career paths, and those two joint venture with each other a lot. Now there are a class of people when they become capital raisers. What they do is they routinely joint venture with other operators, and operators bring high quality deals, and their biggest problem is want to be able to raise more capital. So what happened many years ago is that people would simply just joint venture with each other, and they basically become GPs. So imagine there's 3, 4 GPs in a deal. One found the deal, another manages the deal, and then two raise capital for it, right? Called co-GPs. The problem with that is it's illegal to simply raise capital and then sail into the sunset, right? Co-GP means that everyone is an active partner. Now the problem is in this scenario, even though everyone says, okay, I'm going to be an active partner, what they really want to be is they want to raise capital. They don't really want to do asset management. They don't really want to do any of that stuff. So what can happen very easily is a quote co-GP capital raiser, agrees to do all these things, raises capital, gets a bunch of equity and sails in the sunset, and never attends another asset management meeting. And the other GPs are exposed to a huge amount of liability because they can't control that other partner. So it's a major problem. The whole co-GP thing is actually problematic because it's illegal and it's kind of difficult to manage. And the solution to that is something called a fund of funds. And so, Garrett, what is a fund of funds, and then how does that solve this?
Yeah, so a fund of funds is essentially what's called a special purpose vehicle structure that you use in alignment with an operator to be compliant in raising capital and getting paid and compensated fairly for your ability to raise capital inside of a syndication, essentially. And so you're setting up a fund that you basically set all the terms for your investors, and then you get a preferred structure from the operator because you're bringing in a larger amount of money through your fund. So you're set up as an LP with the operator. You're an LP with the operator, but the mechanism by which you're bringing in your cash is through your own investors inside of your own fund. Your fund has its own rules. And so that's how you make money is you get that preferred structure. So if a general investor is getting like, let's say a 70-30 split with a 7 pref, you might get a 90-10 split with an 8 pref, something like that as a fund manager. And then you can give that other structure to your investors, and you make the spread in between. And so it's a more compliant way to raise capital with an operator. You are in charge of managing all your own investors. You're in charge of doing your due diligence on the operator, on the business plan, on everything, and you stay involved in that sense. But in general, it's not following that co-GP structure where there's so many problems from a compliance standpoint.
Well, that's right. So if you're a fund manager, you're basically you are now a GP of your own fund, and now you're active because all you're doing is raising capital and providing investor relations services and that kind of stuff. So now you're active within the capital raising fund. That's all that you do, and you're not active in the with the operator, which is the entire intent. So it kind of separates the two. And as far as legally structured, just like Garrett said, you're actually a limited partner. Now you are a preferred limited partner. You get some preferred terms. But you are still a limited partner. So it separates the GPs of the operator from the actual capital raisers. So, and the SEC says that this is the way to do it. Now you still have to work with an SEC attorney to set up your own fund, and there's things you got to pay attention to as always, and your attorney will guide you, but it addresses that concern. And so now operators can more safely partner with fund managers, formerly called capital raisers, with fund managers because it's a more legal structure as well. So he talked about how people can make money. So what Gary's talking about is there's preferred terms that you get, not returns, but preferred terms. The idea is the following with a fund, that the fund's investors get about the same returns as if they were to invest directly with the operator, because otherwise they might want to try to circumvent the fund, and that's no bueno. So number one, they want the same returns. Okay. Number two, the fund has to be able to pay his expenses. And number three, the fund manager has to make money. And so that preferred term, that gap that Garrett's talking about, creates that profit margin for the fund. That's really how it works.
Yeah, so it's a really cool thing that's been around for a while, actually, but more people are starting to use this structure because they don't want to deal with the headaches of having the co-GP structure in there. There's people that don't do their job that they're supposed to. There's people that are not like keeping their word on their involvement, and so this is a way to make a good amount of money raising capital. If that's what you like to do and that's what you're good at, you can feel safe about that. And typically, if you're raising capital, you're looking for return on your investment. So like if you, let's say you raise $1 million, you want anywhere from 9 to like 13%, somewhere in that range that you would make on that. So in a million, you'd make anywhere from 90 to 130K, depending on the deal, depending on the sponsor, somewhere in that range.
Over like
Over
5
like
years.
5 years. Yeah.
Yeah.
Exactly. It's not all at once. There's different ways. So that typically you're structuring your fund however you want it to go. But you can charge like a due diligence fee up front, some ongoing fees along the way to manage the money. And then you'll get paid obviously on disposition when everything sells. And so what we've done is set it up where we kind of help people through that process specifically. But in general, this is a product, is something that you're seeing more and more of, and it's a really cool thing that people are doing now.
Yeah, I mean, you really become a fund manager, right? If you're a financial advisor, typically you charge between 1 or 2% of assets under management that you get paid for the fund. And so the more money is in your fund, the more you make. That's the thing. And people don't, after a short period of time, let's say 5 years, they've got 10 or 20 million dollars under management. And 10 million, 10% of that is $1 million over 5 years, right? So it's a good amount of money. That's just over, just having $10 million under management that you've raised over a variety of deals. Now it's kicking off, $200,000 per year for the fund. So it's actually a really, really good passive income vehicle for a lot of people, which is why they do it. And they don't have the hassles of actually having to operate, et cetera. On the other hand, they have to now deal with the investors. Now the operators don't have to deal with all these investors. They just have to deal with one LP investor who wrote a very large check. Now, having said that, though, from a fund manager perspective, the risk for them is that they don't control the operator or the deal that they invest in. So let's talk about, Garrett, some things that they can do to kind of mitigate that, to make sure that they're partnering with strong operators.
Yeah, so you want to get access to their due diligence folder. So like any due diligence they have on the property, that's a really good thing to look into and do your own version of due diligence on the project, the viability of it. If you can get financials from them, obviously on the project and even the underwriting, and then run it through your own process as if you were going to be purchasing it yourself. Now, you should have enough wherewithal and enough, you should know enough about the business to be able to do that type of thing. And I would advise that if you don't have that kind of wherewithal, at least to a level where you can be dangerous, that you shouldn't be uh, running a fund. Essentially, I think this is for people that have some base general knowledge of the investment class and you can do due diligence on the operator, because that's you're really becoming an advocate for these investors, and your job is to find and vet good operators that have a history, that have a track record, that you can bring into a deal safely so that everybody wins and it doesn't end up in a bad situation, right? So going into a deal, you want to just be asking a lot of questions about the viability of it. If you have to make sure that you agree with their assumptions on specific things related to the underwriting, and then make sure that these guys know what they're doing. They're familiar with the market. They're familiar with this type of project. Last thing you want to do is jump in bed with somebody that's a newbie that doesn't really necessarily know exactly how this should go, or they're new to the market, and there's a lot of unknown risk. The types of things that I like to do personally as an operator is I like to be cookie cutter. So you're looking for operators that are more cookie cutter than not, because what that does is it lowers the risk, the overall risk profile of the deal, and increases your chances of succeeding. These projects are hard. They're difficult to run on the other side. And so the less variables that these operators change on their, like changing the entire location or changing their entire staff or people or all those things, the less they have of that, I think there's a higher chance of being successful because it's cookie cutter. They've done it before. There's less variable risk. And so you want to be looking for those types of things as a fund manager before you get into a relationship with somebody and then do a deal with, a sample amount.
Yeah, there's some programs out there that teach you how to raise money online and how to create funds, and people always think that a fund will just help them raise money, and it doesn't. A fund of funds is simply the legal structure in which to raise money too, but it doesn't raise money for you. Same thing, raising going online on social media. People aren't just going to wire you $100,000 just because you're active on social media. And so there's a lot of misunderstanding around this. You need to build a lot of trust with your investors. In order to do that, you need to know what the heck you're talking about. And I get a lot of people who just want to raise capital and they want nothing to do with the back end of the operations. And that's a mistake. To Garrett, what Garrett's saying, as a fund manager, you're not just a normal LP. Okay. You are an actual, you have to know, you have to basically underwrite the operator and the deal itself. You have to know how to underwrite deals. You have to be able to read financials, ask questions about the business plan, about the debt, about how the property will be managed, and things of that nature. Like, you have to know details. It doesn't mean you have to be able to underwrite deals like an expert. It doesn't mean that you have to be able to now interview and hire and manage property managers. That doesn't mean that, but you have to know enough about it. This is why in our environment, when people come to work with us on the active investing side, there's a problem about an even split of deal finders and capital raisers for the same exact reason. Like, well, we don't want to let people graduate as a capital raiser without fundamental knowledge about the asset class. It makes no sense. Also, it makes you feel much more intelligent and credible when you're talking about to investors. And so when we partner with fund managers, we look for people who are asking difficult questions. I want to see them digging around in our syndicated deal analyzer, in our due diligence docs, and asking questions around that, because now I feel better that they know what they're talking about. A lot of people don't do that. And so really get educated around this so that before you do a capital raiser as well.
Yeah, I just think that having starts obviously with the fundamentals, but if you want to be a fund manager, the really cool thing about this is when you get this down, it could be that you pivot into other verticals. It could be that, there's different places you could take this potentially. The sky is really the limit, but one of your key roles as this person inside of the fund is to be able to vet the opportunity and the people behind it. You're betting on the people, yes, but there has to be some kind of track record that you're looking into, getting into the details of each property that they've sold, what those returns look like, making sure that they've actually purchased those and own those properties, like things like that, that you can go as deep as you want on the potential sponsor. And then once the cool thing is once you do a deal, you can see how it goes. And then if you want to continue forward with that person, you continue the relationship. If not, you did one deal, it went okay, or whatever it was, you can kind of pivot off that. But regardless of where you take this, that you're going to have your own process for due diligence in vetting whoever it is.
Yeah. Now, to set up a fund is actually no different than if we or an operator were to set up a fund. It's an SEC attorney. They create a PPM, operating agreement for the entity. You open a bank account. You got to do then, for the fund manager, you have to do some investor relations. You have to you get these reports from the operator, hopefully, and then you can send those reports to your investors. You answer questions. And at the end of the year, you do the taxes and issue the K-1s. That's really it from a fund manager perspective. And what else do we leave off on opening and running a fund? That's about it. It's fairly simple if you rely on your professional team.
Yeah, it's a lot of like the back end stuff. So it sounds overwhelming. It's like, I don't know how to open a fund or what that is, but groups like us will help set that up because we know it's a new thing. We've done all the work specifically on our side where we've actually have like a partner that does all the admin stuff on the backside. So we can make it super simple for anyone that joins into a fund program to do it all. And so and it's not just us, there's other people I'm sure that do the same thing. Make it easy for you to get into this type of thing without having to do all the brain damage of figuring it out yourself. So aligning yourself with groups, whether it's us or someone else that has that kind of hand-holding and understands the structure in the back end, that's going to be critical, I think, to your success unless you've done this before.
So we mentioned a lot that we have a fund that's available for fund managers. If you want to find out more, go to nighthawkequity.com/fund. So if you're a capital raiser fund manager who can raise $500,000 or more, then this would be a great place for you to go and schedule a call with us and have a conversation, get to know each other, learn our process. We'll give you access to a deal room from our previous deal, and so that you can be ready to go when we actually have a live deal ready to go. If you want to become a fund manager, but you haven't raised $500,000 or more, and you want to learn how to do that, then we have a program for that as well, our mentoring program on the active side. So for that, go to themichaelblank.com/call and book a call and find out more about learning all about apartment building investing as a syndicator. Of course, if you want to become a deal finder, but in this case, if you want to become a capital raiser, you're going to learn everything there is to know about syndications, and you're going to specialize in raising capital. You're going to learn how to raise capital one-on-one, and then also how to learn how to raise capital online as well, so that you can raise $500,000, $1 million, $10 million as well. So that's what we got here for you today. Learn all about funds at Fund to Funds, and we'd love to hear from you if you can raise $500,000 or more. Again, that's nighthawkequity.com/fund. And with that, thanks so much. Hope you guys were inspired by today. Go and raise some capital for your next deal. Talk to you later.